0 to 10K, the first real day. We're going over candlesticks, the basics of trading. So, without further ado, let's get it started. Alright boys, I'm ass at recording, so this is the third time doing it. The first time I forgot to plug in my mic, and the second time, the lighting was trash. So I gotta be less slow, and I gotta be more smart when it comes to setting up a good environment to recording. So, candlesticks, what are they? Candlesticks are basically just where price moved in a time frame. A 5-minute and a 1-day candlestick look the same. However, a 1-day candlestick is more elongated because a 1-day candlestick, who would have thought, moved more than a 5-minute candlestick? I know it's crazy. But if you zoom out, you can see that there's a bigger picture. Now I want you to imagine that these are all candlesticks across the chart, because that's what a chart is really, just a compilation of a bunch of different candlesticks telling a story of where price moved during the day, during 15 minutes, during 1 minute, whatever it is. Candlesticks just tell a story about price and where the market wants to move. That's why we use it. So simply put, just to reiterate, a candlestick tells a story of where price moved up or down. The open and the close. And the body just comprises of the price movement in between the open starting point and the closing point. So a body is not the total price action during a 5-minute candlestick, 1-day candlestick. If you include the wick plus the body, that makes the candlestick, and that's the total price movement. Do you see what I'm saying? The wick is price movement outside the body. It tells us where price tried to go to, but failed to go to, and it can tell us prominent lows, prominent highs, and is very crucial towards trading. So identifying how wicks are used, how they're used for lows, spotting support and resistance, all that is very important when it comes to wicks. And we will talk about that going on later with support and resistance and identifying potential liquidity draws and so forth. Next, we have green and red candles. This is rocket science. So if you get this, you're very smart. A red candle, if it goes down, where do you think it opened at? It opened up here and it closed down there. I know it's crazy. And then a green candle, where do you think it opened at? It opened right here and closes up there. So it's very simple. A red candlestick is just a move lower in the time frame, and a green candlestick is just a move upwards in a time frame. One thing you need to understand though is that there can be multiple green candles, there can be multiple red candles. That does not matter. Essentially, a candle going red is basically just saying that the previous move was higher than where this move closed. And the same thing for a positive increase. The previous move, so you see what I'm saying, a green candle and a red candle is just based off where price moves, and it is in comparison to the previous candle. When it comes to day trading, neither are really that bad. It depends on your bias. So having a red candle can be positive, having a green candle can be positive. They're just tools for identification of how price is moving, and that's what we need to use them as. Nothing more, nothing less. Now boys, we get into the juice, we get into the meat, okay? We got dojis. So dojis are simply just a tool used to spot potential retracement. So if there's a doji, this shows that price tried to move upwards but failed, tried to move downwards but failed, and stayed in the middle. This shows indecision. Why does this show indecision? Well, it shows indecision because the market does not know if it wants to go up or down. It's stuck in the middle and waiting to see for the next candle if it continues to be stuck or if it moves upwards or downwards. Dojis are good to spot potential retracements, potential big moves coming after that. The lack of liquidity is a big indicator that a move might be coming towards up or down. And the hammers are very similar. They are tools used to see if there is strong price resistance. So for example, if this is a red hammer and price tried really hard to move upwards, but just ended up back there, it's potential that, okay, there's not really that much support behind going up more. So there might be a potential for stagnation or going lower, which would be favorable if you're going in a short position. And then the same thing for green. Imagine there's a trend going downwards like this, and then there's a green candle like this right here. This shows that price does not want to move any lower. It's tested the range, and it isn't definite that it will move up. I will say that. Do not trade off candles or else you will get smoked. But is suggesting and playing into the confluence that price could potentially move upwards and the move downwards might be stopped. These are both very good for drafting potential. These are both very good for drafting potential predictions for where the market's going to move, which is, what trading is basically just predicting the market based off using prior information, current information, and then identifying trends, identifying confluences, SMT divergence, so forth, that may lead to suggest that price will move this way. So I just want to iterate, it does not really matter if it's green or red. It's still a time of indecision, and it's not going to mean that the market's going to go down because it's red. It's not going to mean that it's going to go up. No, just use dojis as a tool of understanding where the market sentiment is right now. Dojis are simply just used and only used for times of indecision. Dojis are only formed in times where the market is unsure where it wants to go, so don't read that much into it aside from that. So I want to give one more example on candlesticks and bodies just to make it very simple for y'all. So price moves in between 5 and 530. As you can see, that's not in the body, so what is that? That is the wick. Price moves in between 570 and $6. So what is that? That is the wick. Price moves in between 530 and 570. So what is that? That is the body. And all together, they are a candlestick. So that should be all you need to know for candlesticks. If y'all want a video of me on the charts, just going over it real quick, I got you. I can drop that in there. But overall, boys, we're just going to be talking about discipline tomorrow and how it applies to trading. I know I did it for the first day, but I didn't go enough into detail, and there's things I want to talk about. I want to show y'all my calendars, how I'm tracking my trading strategy. Just having everything mapped out and organized as a trader is super important to stay consistent on your strategy and overall just trading overall. Overall. But having everything mapped out as a trader is just crucial to staying disciplined, staying focused, and not just like taking a trade because it's like, oh, it's a shooting star. Oh, like no, you follow your strategy and then you trade based off of that. Oh, but it's a Greystone Doji. Like no. You focus on your strategy and you do that. So having a constant reminder of what you're supposed to be doing and what not supposed to be doing, and further talking about discipline will help y'all know what to do and not to do. So I hope this video helps. Have a good one, y'all. I'll be back tomorrow for discipline.